All right, so for number 2, what we're going to look at is how we handle unearned revenue. Now, this is a topic we've dealt with in the past throughout the semester, but here we're going to look at it in a little bit different situation. So here, we're going to look at this in the context of a concert. So what we see here is that Ticket Sales Inc. received $7,120,000 in cash in advance for ticket sales for a 4-date tour of Bon Jovi. So we're going to record the advanced ticket sales on October the 31st, and then we're going to record the revenue earned for their first concert date on November the 5th, and we assume this is 1/4 of the advanced ticket sales. So if we look at this, what we're going to see is exactly how this process is going to work out. So in this case, what we have is cash that came in of $7,120,000, and this is just the full amount that we received. We recognize this on October the 31st when that cash actually came in. But at that time, we've not yet done the work. And so as terrible as this situation is that we find ourselves in now, it's actually great for this example. Because the reason this has to go to a liability called unearned ticket revenue is because we may not actually get to perform that show. So in this case, with this COVID-19, we had a lot of events get canceled, and that explains exactly why this has to first go to this liability account that is unearned ticket revenue. So at the time the cash comes in, since we've not earned it, we don't have revenue. We've created a liability. And this comes about because of what we called at the beginning of the semester the revenue recognition principle. And with the revenue recognition principle, what we said is that there were 2 main pieces. The first says that we recognize revenue when earned, and the second says that we recognize revenue at the amount we expect to collect. So, what that tells me then is that we have satisfied number 2. We know how much we're going to collect because we've already collected it. What we don't know yet is when this is earned. And in this case, on October the 31st, we've done nothing. So this has not yet been earned. Since it hasn't been earned, since both of those conditions have not been satisfied, we cannot recognize revenue at this point in time. So what that tells me then is that until this condition gets satisfied, until we perform the concert, we don't have revenue. So on October the 31st, this is just a liability called unearned ticket revenue. Now, we're going to move on to November the 5th. So we had a debit on October the 31st to cash, which is an asset, which goes on the balance sheet, and then our ticket revenue, which is a liability, which also goes on the balance sheet. So now that we've addressed that, we can move on to November the 5th. On November the 5th, we have actually performed one of these concerts. So what they tell us is that we're going to assume that the ticket sales basically were even. So each of the 4 concerts is worth the same amount of money. So I will just multiply this times 1/4, and I will come out to $1,780,000 that is actually going to be recognizable on November the 5th after that concert is played. So now if we were to look at a T account for unearned ticket revenue, what we would see is that in the beginning, we had $7,120,000 worth of unearned ticket revenue. But now we've earned $1,780,000, which brings that balance down to $5,340,000. So what you'll see is that this balance in unearned ticket revenue will end on the balance sheet, and this portion has been moved to the income statement as actual ticket revenue. Okay, so that's what we see here. And that's the end of number 2. So hopefully not too bad. Pretty similar to what we've done in the past. Just in this case, it's in the context of a musical question. Okay. So what we're going to do now is we're going to move on to number 3. So in number 3, what we're looking at is how we handle interest on notes. So up until this point in the semester, we primarily talked about 2 types of payables. We've said that those 2 types were 1, accounts payable, and 2, notes payable. We said accounts payable are for your day-to-day operations. So this is where maybe SFA goes down to Office Depot or Staples or something and buys 1,000 reams of paper. And we say, instead of paying you every time we come down here and make a transaction, we'll just pay you at the end of every month. Office Depot agrees. And at the time of the transaction, we debit some kind of office supplies and we'll credit an accounts payable. That's different from what we see here, which is a notes payable. So with notes payable, what we typically see is that these are interest bearing, which means we're going to borrow this money typically for big projects. We need to do additional construction. We need to do something along those lines. It's going to have a long-term effect typically. And so typically notes payable are long-term, although they could have a current portion or be current entirely. But the most common case is that these are interest-bearing and they typically tend to be for more than 1 year. But in this case, we have a 90-day note showing that these can definitely be current liabilities, and that is a $240,000 note at 11% interest. So now that we've reviewed this brief information, what we're going to do is look at how we actually compute this interest. So what we're going to do here is what we call simple interest. And to calculate simple interest, we take principal times rate times time. So in this case, the principal is this $240,000. My rate is 11%, so I'll put that into the decimal, and then we'll take this by time. And if you remember, what we said in class was to always do time over 12 months. That's still true, but in this question, we're not going to do that because this question gave us 360 days in a year to be used. So instead of the 12, we'll use 360. And for the time, this is a 90-day note, so we'll take 90 over 360. So when I do 240 times 11 times 90 over 360, what I will get is a total interest on this note of $6,600. So that's all that we're going to see there. Now, to move into this next section of the question, what I'm going to look at is how this interest needs to actually be divided amongst the periods of time. So instead of just saying, yes, we see that there is a total of $6,600 in interest, now we need to look at how that actually gets split amongst the different time periods. So this will handle this top row in this table right there. However, now we need to look at how we're going to do this for each period of time. So what I'm going to do is I'm going to look and I'm going to say year-end interest accrual. So this is how many days from November the 7th all the way through to December 31st. And if you actually count that out, you'll see that is 54 days. So here, I'm going to calculate interest again. So it'll be the same formula we used just a second ago. I'm just rewriting it so you'll see it again. So it's still principal times rate times time. In this case, the principal, still 240. My rate is still 11%, but now my time, while it's still over 360, is no longer 90. Now it's only 54 days. And when I do this, I will get $3,960 for my interest that needs to be accrued as of December the 31st. See, so what about the rest of that interest? Well, the rest of that interest is going to accrue between December the 31st and February the 5th. And so what we'll see here is that the rest of that interest will be calculated as $240,000 times 11% times 36 over 360. And when you do that, what you'll get is $2,640. And those two together will bring out the $6,600 that we saw right there. So this is the amount of interest expense in the current year. This is the amount in the next year, and this will be our total interest expense that we'll incur over the life of the loan. So now that we've seen where all these numbers come from and how we get them, now we're going to look at the journal entries that associate with these calculations. So the way I'm going to do this is I'm going to come in and I'm going to say the first journal entry I need to look at is that is made on December the 31st. So on December the 31st, I've got to record a debit to interest expense and a credit, not to cash, but instead to interest payable, because we're told we will pay all of the interest expense and payment of the note on February 5th. So we're not going to actually pay cash at December 31st. We're just going to accrue for it, saying, look, we realize there is this expense and needs to be put in this period, but the cash won't actually go out to the next period. So debit to interest expense, a credit to interest payable, and that will be for my $3,960 that we see right there. Okay? Now, that takes care of December the 31st. But now we need to move on and see what happens on February the 5th. So on February the 5th, what's going to happen is a little bit more complex, although not too terrible. So the first thing we're going to do is we're going to debit interest expense again. But in this case, it won't be for the $3,960, it'll be for $2,640. And you say, well, how did you know that's where the interest expense had to go? And my answer to you is this. Well, if you think about that journal entry we did just a second ago, where we debited interest expense and we credited interest payable for $3,960, I know I can't use this associated with this $3,960 here, because at the end of every period, so at the end of December 31st, that expense account would have been closed through retained earnings. And because of that, I know this cannot be what we see here. So in this case, the interest expense has to match the next period. And that's exactly what we'll see. Is we see now the interest expense that we're using is this $2,640 that is associated with the period from December the 31st, or really January the 1st, through February the 5th. And that's what we see there. But we still have to do something with the interest from that last period that hadn't yet been paid. So we have to debit interest payable for $3,960, and then we will end up crediting cash. Now my question to you is my cash just the sum of those two numbers? And if you're following along, I hope your answer is no. Because what you should see is that we want to prepare the journal entry to record the accrued interest expense, which we've done, right? That is this right here. But we also want to record payment of the note at maturity on February the 5th. And right now, if I just do this and credit cash for $6,600, I've not paid off that note. So instead, what I'm going to do is I'm going to debit notes payable for $240,000 and then credit cash for $246,600. Sorry about that. I accidentally hit the arrow here. So I'm going to rewrite this a little bit further to the left. So that'll be $246,600. Okay. And so that is the actual journal entry that we need. And so what we'll end up seeing is that this is the actual sum that we need to get down to this $246,600. And you say, well, how did you know we needed to deal with this notes payable? And where did we even establish that? Because in these entries we've done, I've not ever seen you create a note. And you're right, I haven't. And that's because the question didn't ask us directly to record that note. But I'm going to go ahead and show you how that entry would have occurred, just so you can see it and hopefully make this make a little bit more sense to you. So what I'm going to do is show you the journal entry, even though it's not asked in the question, that would have been recorded on November the 7th. So on November the 7th, we got cash for $240,000. I would have debited cash, which is an asset on the balance sheet, for $240,000. And then I would have credited something called notes payable. And it's a liability for $240,000. In this case, it's a current liability because it's a 90-day note, which is less than 12 months. So we know this is a current liability on the balance sheet. So this is the entry I would have made on November the 7th. Now, when this is actually due, we turn around on February the 5th, what we see is the clearing out of that notes payable account. And that might be a little bit more clear if we see it in a T account. So originally, I put $240,000 in as a credit, and now I'm taking $240,000 out as a debit, showing that I no longer owe this bank any money, or this lender any money, rather. Okay, and that's all that there is to number 3. So hopefully not too terrible, all right? It's very similar to what we've been doing throughout the semester, just a little bit more in there because now we're actually dealing with not just a regular interest payment, but now we're looking at it with different days instead of months, which is slightly different than what we've done in the past. Although I think there was one example of this on a prior homework assignment, but we're just kind of seeing it again here. So hopefully that works out for y'all. Hopefully that makes sense. And we'll move on to the next question. So now with number 4, what we're going to look at is how do we handle employee payroll taxes. So with employee payroll taxes, what we're going to see is up to this point, we've pretty much said we just pay our employees, and we've pretty much ignored how payroll taxes work. But now we're going to see why the cost of paying an employee is more than just the wages that they make. Okay, and so in this question, we're going to look at employee payroll taxes, but in the next question, we're going to look at employer payroll taxes. Okay, so we're going to look at the other side on the next question, but for now, we're going to look at how the employee's journal entries would be recorded, how the journal entries that affect the employee are actually recorded. I'm going to go ahead and clear off this for the next question. Okay, that way we're ready when we get there. Okay. So in this case, what we're told is that on January 15th, the end of the first pay period of the new year, North Company's employees earned $26,000 of sales salaries. Well, right away, that tells me my debit to salaries expense is $26,000. Okay, the most common mistake I will see here is people will jump straight down and fill in $26,000 for salaries payable, and they will forget all of that. Please don't do that. That's not correct. Okay, what you see here is the proper way to do this question. And so we're going to go through exactly how we get to all those numbers. So in this case, it tells me withholdings from the employee's salaries include FICA Social Security taxes at the rate of 6.2%, FICA Medicare taxes at the rate of 1.45%, $4,000 of federal income taxes, $694 of medical insurance deductions, and $170 of union dues. Now, if you've ever worked, all right, and you looked at your check stub, what you'll see is a lot of these items will be coming out of your paycheck. I apologize for that. So when you get a check, you've most likely seen Social Security come out. You've most likely seen Medicare come out. You've probably seen some federal income taxes. And most likely, if you're full-time and you qualify for health insurance, you've seen this medical insurance come out. The one you may not have seen is these union dues payable. And they're not a big deal in Texas because there aren't that many unions in Texas, if there's any at all. But in some states, unions are a huge deal. And if unions are a big deal in your state, then you will see this account more often. In this textbook, they choose to address it. That's fine. It's one more account for you to see, get that exposure to, so it's fine. But just know, if you've not ever seen that come out of your check, that's probably why. Unions just don't have that much sway in a state like Texas. So what we're going to see is that to calculate our Social Security taxes payable, what we're going to do is we're going to take our total salaries that we've earned here, this $26,000, and I'll take that $26,000 and I'll multiply that by 6.2%. And when I do that, I'll get $1,612. And you see that pull through right there. Now for my Medicare taxes payable, I will take my $26,000 times 1.45%. And when I do that, I get $377, which you see right there. Okay. Arrow got in the way of that one just a little bit, so we'll just redo this. Okay. And so there are my two amounts that we see. So you say, great. Well, now how do we get these others? Well, if you look back at the question, it told me the $4,000 of federal income taxes. So that's just a straight credit to employee federal income taxes payable. And then it tells me how much the medical insurance deductions are, and it tells me the union dues. So the only two that you actually had to do any work for were these FICA computations here. Now, there is a phase out for the Social Security tax. There is no phase out or upper limit for Medicare taxes payable. What this means is even though Social Security gets taxed at 6.2%, so Social Security is 6.2%, and Medicare only gets taxed at 1.45%, giving you a total FICA of 7.65%. What this tells me is that there is a possibility I could actually pay more in Medicare taxes than Social Security taxes. And you say, well, how is that possible? Well, the limit on Social Security taxes, so Social Security maxes out at $128,400. And what that means is you don't pay Social Security taxes on any money you make in excess of $128,400. But Medicare has no upper limit, meaning you pay 1.45% on every dollar you earn. Doesn't matter if you make $128,400, $5,000, or $100 million, you're paying 1.45% of that amount in Medicare tax. So if you make a significant amount of money, it's very possible this Medicare tax is actually the bulk of those two tax items that you'll pay. So just be aware of that. Even though the rate is lower, there is no upper limit on your Medicare taxes. Okay, and that's all that there is on this question. Okay, so not too bad. And then we're going to back into this salaries payable as just the subtraction of all of these items. So if you just want to see that real quick, all this is I'm going to take my $26,000. I'm going to back out 1,612, 377, 4,694, and 170. And when I do that, I'll come down to $19,147. And this is the actual amount that goes to salaries payable. Now, salaries payable is the amount the employees will actually receive, not the amount of the expense. Okay, the expense is the total including all of these taxes and withholdings, but the actual payable is the amount the employee is actually going to receive. So this is the amount the employee wants to be large. Okay, it doesn't really matter how large this expense is from the employee's perspective, as the employee is not receiving that money. Okay. So that handles the employee side. So now we're going to move on to the employer side of these payroll taxes. So what you'll see here is there's some differences in the accounts that we're using, and we'll deal with those as we come to them. So in this case, we are recording employer payroll taxes. And in this case, it tells us merger company has 10 employees, each of whom earn $1,400 per month and have been employed since January the 1st. FICA Social Security taxes are 6.2% of the first $128,400. Please do know this amount. It's very important, and it may show up on your exam one way or another. So I strongly recommend you understand and know that $128,400 is the upper limit on your Social Security taxes. So it says that is the limit on the amount paid to each employee. Okay, it's not total wages to everybody, it's to each employee. And FICA Medicare taxes are 1.45% of gross pay. Then it goes on to tell us FUTA is 0.6% and SUTA is 5.4%. So you say, well, what are FUTA and SUTA? Well, FUTA and SUTA are complements to each other. FUTA is the federal unemployment tax, and SUTA is the state unemployment tax. Now, these percentages can change if a company has a lot of layoffs or if they have very few layoffs, but these numbers you see here are fairly typical numbers of 0.6 and 5.4%, and so we'll use those in this case. So what we see is in this case, we're not going to be able to jump straight to our debit. Instead, we have to actually build from the bottom up. And so the way that we're going to do that is we're going to first calculate our Social Security taxes payable. So to do that, I'm going to first, just to save us some time and other questions, I'm going to first take my 10 employees times the $1,400 per month, and that'll give me $14,000. So what I'll use now is instead of breaking this out as 10 employees times 1,400 over and over and over, I'm just going to use $14,000. So I'll take $14,000 times my 6.2%, and that'll give me $868 for my Social Security taxes payable. Now I'm going to do the same thing for my Medicare taxes payable. It'll just be times 1.45%, which will give me $203. Now, to calculate my state unemployment taxes, what I'm going to do is I'm going to take my 1,400 times 10, so back to my 14,000, times my SUTA rate, which is 5.4%, and that'll come out to $756. And for FUTA, I'll do 14,000 times 0.6%, and that'll give me $84. Now, when I take the sum of all of these items, that is where I will get my $1,911 to payroll tax expense for the employer side of the payroll taxes. So this is how we're going to handle this question. Hopefully, this makes some sense to you. Now, if you look down here in the explanation the book provides, they go into a bunch of extra detail that I didn't touch on here. And the reason I didn't touch on it is because it's not applicable to this question, although it is something worth doing. So, what this last question, or what this last piece up here says, is that FUTA and SUTA are only paid on the first $7,000 to each employee. However, we're making this entry in March. And if they only make $1,400 per month, then it's pretty clear that by March, they've not yet hit $7,000 in earnings, which tells me that I don't need to do this check. If this was in, say, September, yes, I would want to do this check, and I would see that I can't actually pay any more on state unemployment or federal unemployment on these people because they've already maxed out. So we'll see a question that deals with this more later, but for now, just be aware that that's what's going on down here. And I'm going to do my best not to give you anything that directly deals with that on the exam that forces you into this check, but just in case you see one, I want you to be aware of it so you might know kind of how to handle this. Okay? But that is the end of question number 5. So now for number 6, right, after we've done 4 and 5, I think we kind of all needed a break. Okay, and number 6 is hopefully going to help us do that. Help us kind of refresh, get back into this hopefully, and give us a nice easy question to kind of roll through and get some points for us. So in this case, we're accounting for bonuses. And so what it tells us is nor company offers an annual bonus to employees to be shared equally if the company meets certain income goals. They want us to prepare the journal entry to record a $10,000 bonus owed, but not yet paid to its workers at calendar year end. Now, the fact that this has not yet been paid is very important, because if this had been paid, instead of bonus payable as our credit, what we would see is cash. But since it has not yet been paid, then we're going to see the bonus payable account come in. So since this bonus is related to work done in this period, the expense related to that bonus must also go in this period. And that deals with our matching principle that we've been seeing for the better part of all semester. And so we're going to debit the employee bonus expense right away. This is an income statement account that is an expense, and it is going up right now. Then we're going to credit bonus payable. And you'll see the word payable, which tells you this is a liability, and liabilities go on the balance sheet. And that question's done, right? So we increased an expense, we increased a liability. We're good to go. Debits and credits balance. This question is done. Okay, so hopefully that makes some sense. Hopefully you understand that one. If you have any questions, always feel free to send me an email. Happy to help you in any way I can. Now, for the next question, what we're going to see is how we deal with warranty expense. So in this case, what we are told is that we made a sale and that we expect a certain amount of warranty expense to be associated with that sale. Seems pretty realistic. So we're going to record warranty expense, and we're going to deal with these repairs that come about as a result of this warranty. So on September the 1st, Home Store sells a mower that costs $320. So there's my cost for $620. Here's my selling price. With a 1-year warranty that covers parts. Warranty expense is at 8% of sales. So what you'll see is that this is going to be dealt with very similarly to how we dealt with our receivables a couple of chapters back in chapter number 7, where we looked at estimating uncollectible accounts, and we said some of our customers, even though they may have the best of intentions, something's going to come up where they're unable to pay us. And we're going to have to account for that ahead of time so that we've got this reserve set aside. Well, that's basically what we're doing here. Although here we're not saying they might not pay us, here we're saying the thing we sold, it might be kind of messed up and it might need to have some repairs done to it within this warranty period. So it looks like to me, if I'm estimating at 8% of sales, I'm probably not selling a super high quality item because that seems like a very large amount to me. Typically you would hope that would be a little bit smaller than 8%, but nevertheless, that's what the question tells us. So on January 24th of the following year, the mower is brought in for repairs covered under the warranty, requiring $43 in materials taken out of the repair parts inventory account. So what they want us to do is record all 4 journal entries for this transaction. So on September the 1st, we're going to have 3 journal entries that have to be recorded. The first deals with the actual sale of the product. And in this case, they tell me that we made this sale in cash. And since we made it in cash, we know we debit cash. So debit cash, $620, and that piece is done. Now, the next piece here is where we credit what they call sales, but what I've been calling sales revenue, just so we're very clear that this goes on the income statement. You want to make sure you get that word revenue in there, just so you know, and you don't have any kind of hiccup where you pause and you're not really sure where that lands. So if you want to refer to it as sales revenue, that's fine. On the last exam, I required you to call it sales revenue. But here, since it's going to be graded through the homework system, if you just call it sales, that's fine because that's all you can do. You're limited by the homework system itself. So we're going to use just sales, but I do want to reiterate that this is a revenue account. It does go on the income statement. It does have a credit normal balance. Now, the next thing that we want to look at is how do we handle the cost? So the assumption here is that we're using what is called a perpetual inventory system. And anytime you have a perpetual inventory system, what that means is that you actually have 2 journal entries every time you make a sale. So you first record the sales revenue, and then we're going to deal with the cost associated with that sale. And this is where we realize we didn't get our inventory for free. And if we didn't get our inventory for free, then we need to show this reduction in the inventory balance on the balance sheet, because inventory is valued at cost. which means on the balance sheet it sits there at cost, but once it gets sold, it gets moved out at cost over to the income statement through the account cost of goods sold. So I'll debit cost of goods sold, in this case for the $320, which was my cost given in the first line of the question. Now, since we've moved it over to cost of goods sold, we've got to reduce it on the balance sheet. So to reduce our inventory balance on the balance sheet, we're going to credit merchandise inventory, and that will go down. Okay. And so now we have reduced the inventory balance, showing that we no longer possess this inventory, and we have increased the expense related to cost of goods sold on the income statement. Okay. Next, and this is the new piece, right? So this is the part that we've not done before, is we're going to record a warranty expense. So in this case, the way we're going to calculate this is I'm going to take that selling price of $620 times my 8%. And when I do that, I'll get $49.60. And that tells me we expect about $50 worth of repairs to come in on this mower that we've sold for $600. Okay? And so to do this entry, and it is just an estimate, right? It's probably not going to be perfectly accurate. But to do this, I'm going to debit warranty expense, which is an income statement account. I'm going to credit the estimated warranty liability. Notice it is an estimate and it is a liability. Because it's a liability, we know it goes on the balance sheet. And because it's a liability being credited, it will increase. So I debit my expense for $49.60. I credit my liability for $49.60. Now, on the next piece, what they tell me is now we actually need to deal with the repair, right? So we said we're gonna give you a warranty, and we're gonna cover this or that. And now our customer's actually coming in, and they're wanting us to honor that. So now we've got to actually deal with this. So I'm gonna look at this through a T account. So I have my estimated warranty liability, and originally we put a credit in there for $49.60. But now our customer actually wants us to make some repairs for them. And so in this case, that was for $43, which is going to leave us $6.60 in that account. So now what I'm going to have to do is come in and reduce this liability. And you say, well, how do I reduce a liability? And the answer is right here. You debit the liability. So I'm going to debit my liability for $43. And then he said, well, where's the credit go? And this is where we got to really read carefully. They actually told me the credit. They said we took this $43 in materials out of the repair parts inventory. And so I'm just going to drag this account title from there straight to here. And so they were nice. They gave me that credit account. And now this question is done. So this right here was really just some extra information, but just to help you see, in this case, it looks like maybe we sent slightly too much over to the estimated warranty liability, but you've also got to remember, this is a 1-year warranty. This was sold in September, and we're already servicing this in January. So there's a very good chance we actually didn't send enough over to this estimated warranty liability account, but time will tell, and we just don't know, right? It's possible we sold this mower, and this is a particularly poor mower, and so it's got some problems. It's also possible this was a minor repair that just needed to be done, and now that that's done, there may be no problems for years to come. We just don't know. But at the end of the day, this 8% really is just an estimate, and all we can do is do our best with those estimates. Okay, and that's the end of number 7. Number 8, what this question is doing is this is calculating what is called times interest earned. Now, what times interest earned is going to do for us is it's going to tell us how secure are we in our ability to pay off our interest. So in this question, what we're going to have to do is we're going to have to actually compute this ratio. And throughout the semester, we've computed quite a few ratios, but this is probably going to be one of your favorites simply because it's very simple to compute. So the way this is going to be computed is we're going to take income before interest and income taxes divided by my interest expense. And when I do this, what I'll see is that I've got $3,610,000 in interest before income taxes, and that's right there, given to us in the question. Park company reports interest expense of $190 and income before interest expense and income taxes of $3,610,000. So what I'm going to see is that now I take that $3,610,000, I divide it by 190,000, and when I do that, I will get 19 times for my interest earned. So times interest earned is 19 times in this question. You say, well, is that a good amount of coverage? You say, well, 19 times seems like a lot. But the answer here is really, it depends. Well, we don't know if this is a good times interest earned ratio or not until we can compare it to the industry. And thankfully, that's what they have us do in part 2. It says Park's competitor's time as interest earned is 13.0. Is Park in a better or worse position than his competitor to make interest payments if the economy turns bad? So if 19 is greater than 13, and it is, then what we will see is that Park is in a better position than its competitor because they're more easily able to pay the interest on their debts. And you say, well, why does this matter? Well, if you can't pay the interest on your debts, it's called defaulting on your debt. And if you default on your debt, then there's a very good chance your debtors are going to decide to call due all of your debt all at once that they hold, and this can put you in a very precarious situation that you would like to avoid. So we want to make sure we are at least able to pay the bare minimum and pay these interest amounts on our debt. Okay? So that's the end of question number 8. Now, question number 9 has us look at net pay and tax computations. Now, I'm going to leave this table that I drew up here earlier, just so I don't have to redraw it. But what we're going to see here is exactly how this is going to work. So in Quick Study 914, we're looking at net pay and taxes. So here it tells me the payroll records of Speedy Software show the following information about Marcia Gottschalk, an employee for the weekly pay period ending September the 30th. Gottschalk is single, that's going to be important, and claims one allowance, also very important. Compute her Social Security tax, and they tell us that is 6.2%. Medicare tax, 1.45%. Federal income tax withholding, and for that we're going to use an exhibit. And state income tax of 1%. And finally, calculate the net pay. The net pay is just going to be her gross pay, less all these things that we've just discussed. So most of this is pretty straightforward. So to get the Social Security, I'm going to take my $615 times my 6.2%, and that's going to give me $38.13. For Medicare, I'll take my $615 times 1.45%, and that will give me $8.92. And finally, for my state income tax, I'm going to call that SIT, so state income tax. I'm going to take my 615 times 1.00%, and I'll get $6.15. And you'll notice there's those three numbers right there. The big question mark here is, where does this $69 come from? And since I wasn't able to get this table to print nicely to come into this document, I just kind of drew it out down here to help you see where this is. So if you pull up this exhibit, right, it's contained within Exhibit 9A.6. Okay, so if you pull that up, right, it's in this exhibit, then what you'll see is a table that resembles this sketch I have right down here. So it says if the wages are at least, in this case, 610 but less than 620, which they are, right? If you were to look at a line, you had 610, you have 620, well, 615s are right here in the middle. So we've satisfied this condition over here. So we are in the right row, right? So we'd come down until we see this row. And then it says now we've got to figure out, well, how many allowances are claimed. Since this table that they provided us was for single filers, we don't need to necessarily care that she's single. But if they gave us multiple tables, we would need to know to go to the one for single filers. So in this case, it tells me that she claims one allowance. So I'll come over as many rows as I need to find one allowance, which is right here. And then I'm going to come down until I hit this cross section between the column of one allowance and the row of at least $610, but less than $620. And I see that that is a $69 federal income tax deduction that needs to be withheld. And that will just pull through right there. Now, if I take my $615 and I back out all of these amounts that we've dealt with here, then I'll take my $615 less $38.13, less $8.92, less $69.00, and less $6.15. And what I will come out to is $492.80. And that'll carry me through this right here on my net pay tax computation. Okay. And that is going to take us through to the end of question number 9. So hopefully that made some sense. Okay. Number 10. There's quite a few parts to number 10. Thankfully, none of them are too terrible. And so what we're going to look at is how we're going to solve number 10. Okay, it's a fairly long question just because of all the parts, but don't let that bother you. Okay, it's not a very challenging question if you just take some time to really knock it out. So they tell me here, Sylvester Systems borrows $195,000 in cash on May 15th by signing a 60-day, 6%, $195,000 note. So on what date does the note mature? Well, that's my first question. So we have to begin on May the 15th. And while May the 15th doesn't count, we'll count 60 days after that. What I suggest you do, especially since this is online, is pull up a calendar and just look and count down 60 days. Right? Each week 7 days. Find the 15th and just go down until you hit July the 14th. And what you'll see is that 60 days after May 15th is indeed July the 14th. Okay? And so that's all there is to question number 1, is we're just trying to figure out when this thing matures. Okay? Now, in question number 2, what they want me to do is they want me to come in here and say, well, what is the entry to record the issuance of the note? Remember that extra part I talked about earlier in that first or second question that dealt with November the 7th, and we had that note? Well, here, we're going to do that extra entry that we did then, but now it's required. So now it tells me to record the entry for the issuance of the note. So in this case, we got cash from the bank. Cash is an asset. It goes on the balance sheet, and it increases with a debit. But we didn't just get cash, right? They didn't give us cash for free. They gave us cash in exchange for a promise. And that promise was to pay them back not just the amount we borrowed, this $195, but also interest as well. So on May the 15th, when the loan was given or received, then we have to debit the cash account for $195 and credit the notes payable account for $195,000. And that's the end of part number 2. Now for part number 3, what they want us to do is they want us to come in here and calculate the interest expense at maturity. And you'll notice earlier when we did a calculation like this, we actually broke it into multiple pieces. But here, this occurred in May 15th. We're paying it off in July. There's no year end in the middle. There's no real reporting deadlines in the middle. So we're just going to record all this interest expense all at once. Okay? And so that's exactly what you see here. Is this 195 times our 6% times 60 over 360. And that's going to break out this 1950 in total interest expense over the life of the note. So same formula we've seen over and over. When we calculate interest, it's just principal times rate times your time. And that's exactly what we see here. Okay. And finally, for number 10, what we're going to do is we're going to come in and we're going to see how we account for a note payable. So here we now need to record the payment of the note at maturity, which in this case is July the 14th. So the total interest expense is going to be what we just calculated on the prior slide, which is reiterated here how we got that, this $1950. The total amount of the notes payable that was borrowed, which is the $195,000 note. And finally, we pay that with cash. So a debit to interest expense, which goes on the income statement. A debit to notes payable, which reduces that liability on the balance sheet. And a credit to cash, which reduces the asset on the balance sheet. And that's all there is to this question. So that takes us through number 10 on the homework. And that's where we're going to cut this video. Now, on the next video, I'll pick up with question 11. And we'll see you there. Thank you.